Welcome back, everyone. Van Richards here again. Now, in this video, we're going to dive into the American Century Ultra performance and its risk metrics. These numbers can tell us a lot about how the fund has fared over time and what kind of ride that investors might expect. Before we get into the specifics, however, I want to emphasize that the past performance does not guarantee the future results, and the value of the investments might fluctuate, sometimes quite a bit. The information I'm about to share is historical and it's not indicative of any future performance. Please stay tuned for important disclosure information that's at the conclusion of this episode. So let's start with the long-term performance. Over the past 10 years, December 2008 through February of 2024, American Century Ultra has delivered an average annual return of about 16.9% after fees. This is notably above the average for its category. However, individual results can vary a lot based on factors like timing of the investments and investment of dividends, reinvestment that is. Now, you might wonder, why do we look at past performance if we can't rely upon it for the future results? That is a great question. And there's actually a strategy for using past performance for judging investments, not predicting, however. If you're curious, I cover this in my online course in a section called Competitiveness in Retirement Plan Investments at planpickprofit.com. But for today, we're going to look at the performance from a historical and an educational perspective. You see, investing isn't really all sunshine and rainbows. We all know this. This fund has had its ups and its downs. You see, in 2020, it had its best year ever with a return of 49.78%. On the flip side, in 2022, that was its most challenging year when it lost 32.46%. These figures illustrate the potential for both significant gains and losses, especially given the fund's focus on high growth stocks in technology and consumer cyclical sectors. Now, let's talk about two very important metrics, the upside and the downside capture ratios. These help us to understand how the fund performs in different market conditions compared to its benchmark, typically the Russell 1000 Growth Index. Let's start with the upside capture. You see, when the market is rising, American Century Ultra tends to capture about 110% of the gains of its relative index. What that means is this. For every $10 of market gains, this fund typically sees about $11 in gain in value. Now, let's talk about the downside capture, or what happens when the markets are falling. During different market downturns, what we may expect is about 127% losses compared to its relative index. That means that approximately for every $10 of market losses, the American Century Ultra Fund might lose around $12.70. Now, these ratios are based on historical data, and they show us that the fund tends to amplify both the gains and the losses compared to its benchmark, resulting in a much higher volatility over time. Now, it's very, very important to note that these are from a historical perspective, and they are not, I repeat, they are not predictions. As an investor, it's crucial to consider whether this level of historical volatility aligns with your risk tolerances and your goals. Remember that the future volatility may differ a lot from past patterns. Now, in our next video, we'll look at the cost associated of investing in the American Century Ultra. Understanding the cost is crucial as it can really impact your long-term returns, although lower costs don't guarantee better performance. Thank you for tuning in, and I'll talk to you in my next video.
Important disclosure information. This publication or presentation is for educational and informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of the publication or presentation. Such views are subject to change. Richards Financial Planning does not guarantee the accuracy or completeness of the data presented herein. Van Richards is a managing member of Richards Financial Planning, LLC. Richards Financial Planning, LLC is registered with the Texas State Board of Securities and governed by that entity and the U.S. Securities and Exchange Commission. Richards Financial Planning, LLC, shall not be responsible for trading decisions, damages, or other losses resulting from or related to the information, data analysis, opinions, or their use. The securities quotes, charts, articles, or other statements regarding the market or additional financial information are obtained from our supplier's sources, and we believe it to be reliable. However, we do not warrant or guarantee the timeliness or accuracy of this information. Our company, our employees, our information providers, guests, or affiliates are not responsible for damages or liable for any errors or inaccuracies related to this publication or presentation. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals or other operational entities should consider if an investment or strategy is suitable for them by referencing their financial position, investment objectives, and risk profile before making any investment decision. The views and opinions of guests that may appear or be sourced with this publication or presentation are not necessarily those of Richards Financial Planning, LLC, and affiliates. Richards Financial Planning, LLC, and affiliates are not associated with the guest and their affiliates unless otherwise stated. Throughout our presentations, we may mention related educational products or services, such as online courses or additional resources. These mentions are intended to provide viewers with optional, in-depth learning opportunities related to the topics discussed. The availability of these products does not affect the objectivity of the information presented, and viewers are under no obligation to purchase any mentioned products or services.